You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The junior space has attracted a lot of unscrupulous characters through the years. They've tried to separate investors from their money. I mean, there's an old Vancouver saying that, in the beginning, the promoter has the vision and the investors have the money. And in the end, the promoter has the money and the investors have the vision, right? So, you have to keep that in mind.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, and in today's show, you're going to be hearing from Greg Orrell. He is the president of Orrell Capital Management, and he also is the portfolio fund manager of the OCM Gold Fund. To learn more about that, you can go to his website, ocmgoldfund.com. Greg, welcome onto the show for the first time. It's a pleasure to meet you and have you on the show. And you've been in gold for many decades. So tell us a little bit about how you got into gold. And as you do that, could you compare gold to Bitcoin and let us know where you stand on the whole gold versus Bitcoin debate, please?
All right. It's great to be on, Bill. And first off, gold started basically at the dinner table. My father was a broker in San Francisco, and one of the early gold brokers, stockbrokers in San Francisco. He actually was on, used to be interviewed every morning on a radio show, and they called him Mr. Gold. And then he started a gold mining company up in the Mother Lode Belt of California that ultimately became a mine. So it was, one of those things you grow up with. So a lot of experience early on. I can remember, these are mid 70s, on this old, we had a project up in the Mother Lode Belt of California called the Royal Mountain King Mine. And, one of my earlier experiences in the mid 70s was going up there with my father. We'd camp there. And, one time, Jim Dines was a friend of my father's, going up in his Rolls Royce and going over, doing a little mine tour, property tour in the backseat of Jim Dines' Rolls Royce.
Famous newsletter writer, right?
Right. Yeah. So been in the space for a long time. Started off as a stockbroker in the mining space, dealing only in gold and silver, mostly junior miners at the time. And then in the mid 90s, one of my clients was had this small fund called the Monotron Gold Fund. And so they said, "Oh, well, Greg, do you want to take over managing it?" And I said, "Oh, sure." I didn't know anything about the mutual fund business at the time. So I said, "Sure." And, got an introduction into the gold fund mutual fund business at that time. And, so now I've been doing it for about 25 years. And that's my take on getting into the gold business. Regarding Bitcoin question, I do get asked that question all the time, and everyone's saying, "Well, isn't Bitcoin siphoning off investment flows into the gold sector?" It could be on the margin at the moment, but at the end of the day, gold has shown to be a store of value. Bitcoin has yet to do that. Whether the electricity goes out or, gold, for example, gold, if gold goes down, in a shipwreck, 100 years later, you find the gold is still worth something. It's a store of value, and it's shown to be, gold has all the monetary attributes, whereas Bitcoin has yet to do that. And, there could be Bill coin, Greg coin, granted there's the premise behind Bitcoin is correct in terms of, okay, I'm trying to have something that is a store of value that's not being debased by the central banks. Whereas I just think the vehicle is wrong, because the scarcity argument of there's only 21 million Bitcoins or X number of Ethereum or Doge coins, but you can keep creating all these coins. There's no scarcity of how many cryptos that you can create. And so, but they're trying to talk about market caps, and they're making up reasons, the proponents for for Bitcoin and cryptos, in my opinion. So, like I said, I think the premise of why people want to be into cryptos and Bitcoin, et cetera, is correct. I just don't believe the vehicle's right. I still ultimately believe that the money will gravitate, capital flows will gravitate back towards gold.
Thank you for that overview and sharing your position on that. All right, let's talk about gold stocks. You obviously have been investing in gold stocks for decades, as I kind of alluded to in my introduction, from the gold cycle from 2000 to 2011 versus the expected gold cycle that we're in now. What are some of the differences? How do you see this gold cycle as different, and how might gold speculators benefit in terms of how they position themselves in this particular gold cycle?
Okay, so first off, from 2000 to 2011, and you were coming off of at 2000, 2001, you were coming off of a terrible bear market. Gold had gone down to $250. Everybody had sold out of their gold positions, and nobody had any desire to be in gold. I mean, gold, was the four-letter word, for everybody, and everybody was looking for growth stocks at the time. And what obviously changed was, 2001, you had 9/11, you had the Fed start to come out with, extreme monetary policies, and that was actually on top of previous aggressive monetary policies following long-term capital and Asian financial crisis. So when the dot-com bust came, that was thrown on top of those, and then you had the housing crisis that took place in 2008, and all those extreme monetary policies have gone to create an environment that allowed gold prices to move higher. As especially one of the things, if you look at gold, it's highly correlated to total federal debt outstanding over the last 50 years since Nixon closed the gold window. You have a 92% correlation, the gold price to total federal debt outstanding. Everybody likes to talk about the inverse relationship between the dollar index and gold. And, one of the things, if you were to plot the dollar index and gold price, you would see that the dollar index, basically is flat and the gold price goes up. The dollar index is an index versus other currencies, and it's not against gold. And so it doesn't take into consideration the debasement of, those paper currencies. So where we are now is, we are in a much better environment for the gold shares than we were in 2011, in my opinion. One of the things that took place with the miners is that they have a history of debasing shareholders, and their equity issuance really caught up to them in 2008. We saw a blowout of the gold XAU ratio. One of the things that, if you were to look at the gold XAU ratio, which is the gold price divided by the XAU index, you'd see that historically, since it was started in 1986, it traded around 5 times, and it blew out to 26 times. And that coincided with a loss of investor confidence that was taking place. And you could blame it on poor capital allocation, but it also coincided with the big deluge of equity issuance, which I would say that the miners were debasing shareholders faster than the central banks were debasing currency. So what we're seeing now is we're seeing a contraction of equity in the top 10 producers, and whether it's the Newmont buybacks or other buybacks, there's greater confidence in management, better capital discipline. I mean, you could say that Mark Bristow, when he went over to Barrick, from Randgold to Barrick, helped fuel that confidence of investors. And we're seeing a contraction of that gold XAU ratio now. I mean, that's important because what it does do is, if you move from, currently around 12 and a half, if you go back to that historic number of 5, and if that's the direction we're going, that's a big move for shares in terms of outperformance relative to the gold price. So I just believe that there's a better understanding that the majors, and intermediates, that the shareholders need to participate in the cash flow, and we're seeing that in shareholder returns. There's this balance that has to go on between the cash flow for the miners, for what is a sustainable balance sheet, what do they need in terms of cash flow to sustain the business and make it investable long term, rather than just a trade. So I believe they're doing a good job of managing that, and I think that's starting to drive better investor sentiment.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project, with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com. When you invest in major gold producers like your fund does, do you want to see them giving a dividend, increasing a dividend, or would you rather see them reinvesting that money rather than giving you a bigger dividend?
It's a balance. I mean, I know that's an argument that a lot of folks have. But you have to realize that, in my opinion, the miners need to pay the shareholders along the way, because it does become a fool's game. If you were to take money and put it in one hole in the ground to the next hole in the ground to the next hole in the ground without paying the shareholders along the way, it really is a fool's game. You're just trying to get bigger for the sake of getting bigger, and but what do you get out of it? It's a depleting resource business. So the shareholders do need to participate. And back in the 70s and before, even in the 30s and 40s, the miners always paid big dividends. And some of them, they paid too big of a dividends and they couldn't reinvest. And so there is that balance that has to be done. And so, when I look at for new projects, in my opinion, the returns need to be high enough. And, what is that number? I like to see 30% rates of return, especially for 10-year projects. And, it's a simple math. It's, 10% to pay back the project, 10%, should look after the shareholders, and another 10% for the next mine. So
you're running a gold fund. Obviously, you invest in some of the bigger gold producers. But when you move down the food chain, can you talk us through what you look for in maybe a small cap or even a micro cap gold stock?
Okay. So, I'll go back a little bit in history here. So, the junior space has attracted a lot of unscrupulous characters through the years. They've tried to separate investors from their money. I mean, there's an old Vancouver saying that, in the beginning, the promoter has the vision and the investors have the money. And, in the end, the promoter has the money and the investors have the vision, right? So, I mean, you have to keep that in mind. And so with that said, though, there has been a lot of talent that has migrated to the junior exploration space. And so what you do need is, a good solid geologist that has the technical capabilities and has the imagination that is necessary. I mean, it's one thing to have, technical capabilities, but if you don't have the imagination to make a discovery and put it all together, you're probably not going to come up with a big discovery. And then you have to have the capital. You have to, in a large mining company, you'll have a champion of a project that'll push it through. For a junior, they have to have access to the capital markets. So they have to have a board that has that ability to access the capital markets. One of the things too, Bill, is that you go through cycles, and you'll see projects that come and go, and they've been through multiple cycles, and it will probably take multiple cycles to make a project become a mine because of the ebbs and flows of the capital markets. So, so that's what you have to look for is quality of assets. Can you turn can the project actually make it on its own? Quality of the asset and quality of the people. Management at all levels in this business is extremely important.
When you get burned by a management team, which is a lot of times the biggest risk of speculating in these smaller gold stocks, did you ever give anybody a second chance, or how have you interacted?
I never give anybody a second chance.
It's one and done. Fool me once, your fault. Fool me twice, my fault. Kind of perspective then.
Yeah, you'll see that most folks, a lot of people sitting where I'm at, if they've been burned, and that's one of the things that you do. If management, whether it's a large company or it's a smaller company, if they do something different than what they said they were going to do, that's a sign to be a seller. And so management, if they lie, and there's plenty of examples of folks telling stories that aren't true, especially on the exploration side. So one of the things over time that you learn is that what are some simple back of the envelope things that allow you to try to see what a mine is going to look like. And it's a lot of it is geometry of a deposit. It's metallurgy, strip ratios, and grade. All those things. It's not necessarily rocket science, but you do have to be able to try to ascertain that early on for yourself. So,
one more question about management. If you see a manager of a company involved in several other junior mining companies, is that an immediate turnoff for you? Or, how many companies being involved with is too many for the leader of a company you would invest in?
I would say that there's a certain level of distraction that takes place. And it's one of the things that you'll see is, if someone's, successful in a project and it's going along, and then all of a sudden they get involved in another project, you should probably get out of the other one, the first one that you were in, because all of a sudden the attention is no longer there. And so, so you don't want to see somebody involved in, if they're the main guy of a project and not the promoter. I mean, there's a difference of, you got a promoter of a project who's helping to access the capital markets. That's one thing. And there's another who's the main driver of a project. And it might be the geologist or the original backer of the project. And so what you have to do is, make sure that you don't have management that's distracted. And I would say, as soon as they start going off on, more than one, if he's the main guy, that's time to leave.
Greg, I was having a conversation with someone very seasoned and experienced in the sector, and he mentioned a specific gold exploration company. And I said, well, I wouldn't touch that with a 10-foot pole. The share price is where it is because of speculation and promotion. And he said, well, I know that. He said, but 3 months ago, I bought it for this price. And a couple of weeks ago, I sold it for a triple. So he understood the whole game, how it's played. He understood the geological potential of what they were doing, how far the spacing was. You couldn't fool him. But still, he made a triple off of it just because he understands how the markets work. Would you ever buy a gold stock just knowing that it's going to go up based on speculation and promotion?
I don't, no. Yeah, but I fully appreciate the game, understanding of, okay, these guys, the promotion's coming in and I want to be in front of the promotion. It's like, being the first guy on the when they're out on a marketing tour. They start on the West Coast and they're going to go to the East Coast. You want to buy it on the West Coast, sell it by the time you get to the East Coast. So, but no, my turnover ratio is historically very low. And, what I like to do is, I keep my winners and, sell my losers. And that's worked out well over time. And so on juniors, what I'll do is on, exploration companies, I'll buy small. I won't buy something. I don't need to take an outsized position on an exploration company. And I don't want to be the bag man holding it either. There's a certain cycle to an exploration company. There's life cycles. And what happens is, as soon as you go into a bear market or capital is leaving the gold sector, the bids just evaporate for junior explorers.
And then on that note, what's your exit strategy? Because you're running a gold fund and gold goes in cycles. So, what is your exit strategy to exit out of these positions?
So, you sell, what those are usually, what happens is mining fund managers tend to get caught holding positions that they can't get out of. And so you have to right size your portfolio, and you have to make sure that you don't, sell your best to hold your worst. And so you sell, even if you don't want to be a seller of, some lousy, company, that's is going to have difficulty raising capital, and you might be putting more pressure on it. You do sell those companies.
And then in terms of the gold cycle, do you have like a gold price that you have in mind? Or are you just going to be monitoring the macroeconomic environment, for when you're going to sell out a Barrick or a Nico Eagle?
Well, what happens is you will look at, where you are on the cycle. And so, right now, I'm extremely bullish on the producers. I think they represent good value here. So I'm actually bullish on the juniors, junior producers and intermediate producers, and a lot of explorers. But I still believe we're early innings in this cycle.
So we've talked about a lot of pitfalls and things to avoid, as well as things to look for. As we conclude here, I believe your fund makes your positions public. Is that correct? So. Would you want to share a couple positions that you have that are smaller cap as examples, or can you not?
I prefer not. I just don't want to be the one talking my book,
Okay.
And, but what I will say is that what you want to look for, or which gets discounted in this space a lot of times, is time. Because it takes a lot of time to permit. It takes a lot of time to go out and explore. And you'll go through cycles where that capital is spent and it gets discounted. So the capital is discounted and the time is discounted. So you want to, as an investor, you want to look for opportunities where you believe that that is an economic deposit, and there's been time and capital spent previously. That creates opportunities. Obviously, there's new discoveries that are being made, and that creates a lot of excitement. But you have to realize, if that's not a truly spectacular type of deposit that's going to make it through the economic cycle, you may be caught holding it. So, but there's a lot of there's a lot of opportunities, I think, in this space. Especially as capital flows start to come in. And for me, the gold price outlook is positive, just because of what we're seeing is more debt being put on, and Powell and Yellen getting together to finance that debt. That is a bullish environment, for the gold price going forward, in my opinion.
Absolutely. So, Greg, your website is ocmgoldfund.com, and anything you want to let listeners know about what they'll find there?
What they'll find there is that the OCM Gold Fund has been around a while. It's a smaller fund, so we have a lot of flexibility in where we can invest in terms of the micro caps and the large caps. We are, won the Lipper Award last year for the best 3 and 5 and 10-year performance. We have shown that we have the expertise to, for our shareholders to deliver, returns that they're looking for. And, we are we take it from a monetary perspective and we want to be that monetary gold asset for our investors.
Excellent. Well, thank you for coming on today's show, Greg, and sharing your experience and expertise. Much appreciated.
Thanks, Bill. Appreciate it.